Hooty hoo, everybody. Welcome today. I'm Tall Mike. It's Friday. Made it till the end of the week. Guess what? We've got another down week in the making. That's 7 down weeks in a row. I thought we were going to bounce this week. I got that one wrong. We actually took out last week's low just right before I recorded this. It came down, took out that low, down about 500 on the Dow, about 300 on the NASDAQ. I think we're starting to recover a little bit. Look at this market can go lower, absolutely, but we're down about 30% on the NASDAQ, about 20% on the S&P. All right, at some point this is spring-loaded. It's spring-loaded. There is going to be what's called a bear market rally, right? It's a short covering rally. Everybody's piling into the shorts right now. And they're making money. It's the right move. Why not? So they're all piling on. But at some point, this market will get a short covering rally that will be a very large rally in my opinion. Now, will it happen next week? I believe it will. We'll see what happens. I have a few small positions on. I wouldn't go large positions on either direction right now, but I do have some small positions on for this short covering rally that I still am expecting. I thought it would be this week, but it looks like we're going to get that 7th down week. And if we get down next week, that'd be 8 in a row. That's pretty impressive. Not very often do you get 8 straight weeks down. Just doesn't happen that often. This thing's spring loaded, it's tight loaded, and it will recoil and it will rebound in the other direction. Mark my words. All right. So what I want to talk today about is, I want to talk about some economic stuff mixed in with some real estate stuff, all right? And economics is really just common sense, right? Supply and demand. When more people demand houses than their supply, the housing market goes up. And it's been doing that for the last, 12 or 13 years straight up, right? Because supply has been in short supply and demand has been much higher than the supply. Well, what's happening right now in the housing market? Well, that demand is starting to fall off a cliff. People are starting to see the light of day. They're starting to go, hey, this 5.5% mortgage stuff, I don't want any part of it. I think houses are going to go down. The buyers are backing away. So the demand is going down. But what's also happening? The supply is moving up. Now, pretty soon they're going to be at equilibrium, right? They're kind of bobbing and weaving, but when you get to equilibrium, that's where you get the flat market, and the market doesn't go up, it doesn't go down. But when you get more supply than there is demand, it starts to go lower. Now, people don't understand this. All right. So what happens, and I like to do an analogy, just take 100 homes. If there's 100 homes and there's 4 of them for sale, right? Okay, but there's only 2 buyers, but 4 people have to get out of the market. Where does the market go? Well, it goes down because 2 people are going to make it out because there's 2 buyers left, right? But 4 people have to get out. Now, what about that 3rd and 4th guy? They will lower their house to any price just to get out. They have to get out. They have to. Maybe it's a divorce and they just hate each other and they have to get rid of the property. They will take any price to get out of that property. I've seen this time and time again. But this is what's known on the margin. The first 2 don't hurt you because there's 2 buyers. But if there's only 2 buyers, that 3rd one hurts you. Now, what happens when that 3rd one drops it down? He may drop it 10, 20, 30%. He has to get out. He has to find a buyer. And at some point, the buyer comes back in and says, hey, I'll take one. Or maybe someone says, hey, I'll take a second house. And they come in and they buy that at a lower price. Well, now what do you got? Well, you got what's called a comparable. Okay, that is a comparable for the neighborhood. The whole neighborhood just dropped in value. I got news for you. Just because of the margin guy, that whole neighborhood came down in price. I know that doesn't seem fair, but that's just how it works. There's these people called appraisers. Appraisers will come out and go, no, we can't appraise it higher than that last sale because that's the most recent comparable. Now, what about the 4th guy? guy. The fourth guy has to get below the third guy so that his home can sell, right? He's got to find a buyer at any cost. So these are the people on the margin. It doesn't take a lot of people to start selling to bring the whole housing market down. If the buyers go away, which they're doing right now, demand is dropping off, supply is coming online, what happens? We get the equilibrium first, but then supply overshoots the demand and the prices start to drop. And they can drop quick. They can drop overnight. And people are starting to wake up. They're starting to go, hey, 3%, just back in December, and now it's 6%. I'm not buying here. I'm not buying until the prices come in. And the prices will come in. Now, there's what's out there is what I call it. Well, it's a shadow inventory, right? People say there's a shortage of homes. I say there's this shadow inventory. Do you know how big that is? It's about 15 million homes. 15 million. Give you an example. Right now, we probably have about 800,000 homes for sale in the U.S., but there's 15 million vacant homes. Now, who owns these homes, right? Well, a lot of it's big corporations. Corporations like BlackRock, like Blackstone. I mean, these are corporations that own 100,000 homes. They don't even know where their homes are at. They just know they have 100,000 of them. Some are waiting to be rented. Some are just sitting vacant. Some need repairs. But there's a shadow inventory out there. Now, a lot of you think that the big corporations are going to swoop in and buy all these homes that are coming for sale. I got news for you. They're not going to. And here's why. All right, so corporations, they don't buy homes like me and you buy homes. Me and you, we go get a 30-year mortgage. They don't do it that way. No, how they do it, corporations, well, they sell their bonds. That's how they raise money to buy these homes. That's how BlackRock and Blackstone raise the money to buy the 100,000 homes they own. They sell corporate bonds. Now, corporate bonds are typically anywhere, let's call it 2 to 5 years. And they have to refinance these bonds. They have to roll them over. They have to sell them again. And the higher that interest rate goes, the higher price they have to pay for money. Right now, corporate bonds, if BlackRock and Blackstone's probably around 2.5%, right? Hey, but what if that shoots up to 4, 5, 6%? What happens? Well, right now they're making money on their real estate investments because they're renting them out to you and me, and they're getting about 4 or 5% return cash on cash. They borrow the money at 2.5%, and they roll it out there, and they rent them, and they get 4 or 5%. And that's really good, right? Because at 2.5%, they're paying on the money, but they're getting 4.5%, maybe 5%, right? Okay, but what happens when that 2.5% interest rate, the bonds that they sell, that 2.5% goes up to 5%? Well, they rent them out and they get 4.5%. Well, now they're losing money. Shareholders not happy. This can happen really quick, and they will start to dump their inventory. But they will start to dump their inventory in what will be a falling market, because as interest rates go up, home prices go down. So the BlackRocks, the Blackstones, now it's only 100,000 each they have, and they'll start to dump their inventory. They'll start to dump it onto the market in a falling market, which means they have to drop it low to get under the bid of the next guy. They are now the margin players. They are the ones that are on the margin. They will adjust the house prices for you. Now, people say that, well, that's never going to happen, Mike. Well, look at, all right, let's just look at China, right? You got the Evergrande thing, but you got Sunak. It just came out and defaulted on $742 million in bonds. You see, they do the same thing we do in the U.S. They sell bonds, and then they go either build houses or they buy houses. Well, they can't make their payment because they're broke. And I think some of the developers here are going that direction because they're not going to be able to sell their inventory at the price that they need to sell it at, because their building costs have gone way up, and now interest rates have gone way up. They have to sell those homes for a lot of money to make profit. They're not going to get those homes sold. They're going to have to drop those homes on the market at any price that the market will give them. Look at it. We're changing right now. We're in transition. We're going from a seller's market well, it's been a seller's market, but it's shifting. It's going to a buyer's market. The buyers are soon going to be in control. That equilibrium we talked about, as soon as that supply outstretches the demand, the buyers become in control, and they dictate the price to the sellers. Right now, the seller sits back and he says, hey, I got 3 offers. They're all above asking, but I want to wait and see if I can get a 4th offer that's even higher up than the 3 that I have. Well, this is all changing. The multiple offers are going away. The buyers are going to start to take control, and they're going to take control. Why? Because the equilibrium is shifting. The market is shifting. It's transition. Companies are in trouble. I'm telling you, home builders are in trouble. Toll Brothers, Lennar, Pulte. They cannot get their homes sold. It's a dash to the market. They're all going to be rushing their inventory to get it out the door before the other guy gets his out the door. Because in a falling marketplace, they have to be first to get their inventory out. Otherwise, they have to take a lower price, and the prices keep dropping down. Now, people will tell you I'm crazy. In my area, it's impossible. Things never fall in my area. Look, it just takes the buyers to go away and some people that have to sell, that have to get out, to bring down the comparables on your street, in your neighborhood. It brings the whole housing market down. If you're thinking about getting out, it might be a good time to get out. Look, you can hold through this. Look, in 5, 10, 15 years, we'll come back to the prices that we're at now. I believe that. I believe we will eventually make it back, but it's going to be a long, long time. And I do believe that we're going to see that 40, 50, 60% off in the housing market. And it's because of the margin. It doesn't take, everybody doesn't have to sell their house. Just a few people have to be willing to sell, need to sell their house without the buyers. If the buyers go away and people have to sell, the whole marketplace comes down. I hope this made sense. I know it's a little bit of a ramble. The stock market, let's go back to that real quick before I close off here. We got 7 down weeks in a row. This thing is coiled tight. It's ready to spring. There's going to be a short covering rally. Will it be next week? Will it be the following week? That I'm not sure, but it's coming soon because we are oversold in a coiled up position waiting to spring out of this, and then the shorts will have to cover their positions, and it will just be it's going to be a big rally. I'm telling you. Anyways, that's my opinion for the day. I'm Tall Mike. You like this stuff? Hit me at the thumbs up. Really like it. Hit that subscribe button so we can talk more next week. Get out there, everybody. Have a great weekend, and I hope to talk to you again next week. Bye-bye now.